over in Nigeria, we've seen Fidelity Bank's full-year results emerge, the bank making a profit of 2.05 billion naira, making it one of the banks in the Nigerian space that had not made a loss through the turbulent period last year, but still falling short of expectations. So joining us live from our studios in Lagos right now is the company's CEO, Reginald Ihejiahi, and he joins us, of course, live. Reginald, thanks so much for joining us this afternoon. Well, we've had the bank's results come in, pre-tax profit dropping 46%, PAT down 23% for the full year period, while turnover more than halved. Run us through the business's pressure points. Despite the fact that this has been a profitable business throughout the downturn, there are pressure points that are clearly at play here.
Well, I think, Alicia, the important thing for us is that the period you referred to has been a special period. And you know what has happened. I don't need to go through those things. And the results you're also referring to were results for 6 months. So it's not results for a full year. It's very important to underline that. In terms of pressure points, the first thing, of course, was that the regulator rightfully asked banks to clean up their books. And that Fidelity, like all the other banks, have done. Very important. And they have also set down a roadmap where they want to be in the future. Very important. But I would rather spend time actually talking about what Fidelity wants to do for the future and what we see 2010 working out to be.
With that being the case, I mean, there's got to be a strong focus on
what's happening.
Sorry to interrupt, but with that being the case, there's going to be a strong focus on your provisioning levels. I mean, we knew that level of provisions would provide a major weight to your bottom line. Coming in at 1.9 billion naira in September 2009, we had full year forecasts suggest a figure closer to 3 billion naira. Where are you actually sitting right now?
Well, where we are sitting, if you understand the prudential guidelines here in Nigeria, is that the worst is over. We are about to run off the provisions required on the identified non-performing loans. And of course, the bank now has very, very strong processes in terms of its risk assets. We've always had. And I want to make this point too. The regulators, for example, came out just this month with an exposure draft or are thinking of that for new provisioning requirements on the prudential guidelines. The Nigerian prudential guidelines have not been changed since 1990. And if you read the new proposals, you will see that if they applied to the loan book as it was, as at December 30th, 2009, or even as at January 30th, 2009, we would actually have been seeing a different results entirely in terms of the mandatory provisions to be had. We also, of course, have been looking at our accounts that we have written off because we see that as a great opportunity if you're able to recover those loans, especially the lost accounts. They go straight into income. So that's part of what we are focusing on now.
So where we've seen this
in terms of other areas of emphasis,
sorry, but where we've seen this 25% decline in loans in advances, what's your strategy moving forward in this regard? Are we going to see some loosening of those credit lines?
Yes, that's already happening. In fact, just to give you an example, yesterday we actually commissioned the first can-making company, the biggest in sub-Saharan Africa. It's producing 600 cans per annum, and all the capacity has been taken off. Last month, we also were at the commissioning of the power plant, which we financed, is a 12.5 megawatt power plant to supply power to the Lagos State Water Corporation. These are captive projects, and we are moving more and more towards those kinds of projects. We'll, of course, continue to stick to our bread and butter business, which is the commercial end of the business, which is commercial banking. Because Nigeria, as you know, is an import-dependent economy. Many of our customers are actually importers, while we try to add to that a strong corporate bank focus.
What role do you see Fidelity playing in the possible consolidation of the Nigerian banking sector, the foreseen merger and acquisition activity that is being anticipated?
We are very excited about that. But of course, Fidelity has always been a cautious institution in terms of doing deals. As you know, the new Fidelity required the old Fidelity to acquire 2 institutions. So we have experience in the mergers and acquisition business. And those 2 deals did not involve us having to carry goodwill on our books. So it's an important point to make. We have an experience in that. We are going to be very rigorous in our process. But in terms of opportunity, we think that there are good opportunities to do a combination with any of those institutions. And we are choosing our targets very, very carefully.
In that context, you've maintained a tradition of a dividend payout to shareholders by proposing a 2.5 kobo for every 50 kobo share held. Do you have enough of a war chest to actually drive this ambition moving forward?
We have. In fact, if you look at our balance sheet, you could see that our capital adequacy ratios are way above the regulatory minimum of 10%. We're actually at 45%, which is quite large. So we have the capacity to do that. There are also other options that we are looking at in terms of making a deal that guarantees us a very, very strong future. And I think at the appropriate time, we'll be disclosing those options. But the important thing is that we are very happy with the way things are going. And we are also very happy the way the business will go in 2010.
What's your outlook for growth this year, just to wrap everything up, Reginald?
This year, I think starting from a position where the industry was actually really, I would say, traumatized, and where credit extension wasn't happening as much as both the banks and the regulators would like to see. This year, we think that we will actually get our loan book up, possibly by between 30 and 25 and 30%. And the character of these loans will reflect some of the kinds of customers I had indicated to you. A lot of more in the manufacturing business, a lot more in the established oil and gas business. You know, the local content bill has just been passed into act, and we have a lot of customers in that oil and gas business who have not had the opportunity to try their hands in big transactions. We're talking with them, and we're looking at that area as well. But in 2010, we are really very confident.